Time now for our 360 round. For that, I want to bring in our panel to discuss Dick's Sporting Goods off the back of its quarterly results. We've got Svetsa Kalinska, consulting founder and CEO of Rela Global, and David Swartz, senior equity analyst at Morningstar. David, why don't we start out with your take on their earnings? They did beat expectations on top and bottom line. Adjusted EPS $4.38 per share. Revenue topping $3.6 billion. Comps rose 5%. They raised their full-year comp sales guidance, but the stock is selling off now. What's your reaction to its results?
Yeah, it was another good quarter. This isn't really surprising. Dick's has really outperformed just about everybody in the sporting goods space over the last 5 years, and it's consistently beaten estimates, and that happened again today. I do think that there's some concern about the tariffs and the outlook for the rest of the year. Dick's only raised its guidance for the year by about 10 cents, essentially, which is actually less than the quarterly outperformance. So it didn't really increase its guidance. However, that's sort of secondary at this point because Dick's is about to close the acquisition of Foot Locker, and realistically, the company is about to change radically. That deal is supposed to close in about 2 weeks, and that's going to completely change Dick's outlook. It's also going to affect its margins and sales growth because Foot Locker is underperforming Dick's by quite a lot at the moment, and acquiring Foot Locker is going to have a depressing impact on Dick's margins.
You're not the only one who has that view, David. So, that may explain also the shift that we've seen because the initial stock reaction was positive off the back of its results. And Svetsa, you often do, obviously, channel checks about what consumer sentiment is as it relates to different companies. One of the things Dick's highlight is they said ticket transactions increase, traffic increase. What are your channel checks showing you?
I analyze consumers and I analyze marketing strategies. So just in the last 30 days, Dick's Sporting Goods has had just about 70,000 mentions online, which for such a big brand is actually such a nominal number. I mean, it's almost irrelevant because consumers are not really going online and talking about the brand. What consumers are talking about, though, are their experiences, so both positive and negative. And I think that yesterday's earnings actually do showcase basically what consumers think. I'll start off with a really quick highlight of the positives, which are related to their product quality and the variety, and then a lot of the launches that they're doing. So they have in-house studio launch and community initiatives that they've taken on. But when it comes to the negatives, I think what they missed in the last quarter was actually the opportunity to leverage the marketing campaign that they did in partnership with big stars like Tom Brady. So that campaign, which launched in Q1, so just in March 2025, could have really helped Dick's move the needle when it comes to stock performance and earnings, but instead it actually missed the opportunity because the spotlighted message that Tom Brady and the other superstars did was that actually the brand is not relatable. It's only for athletes, and that actually alienated some of their consumer base.
Okay, all right. David, I want to go back to the thought that you were bringing up about Foot Locker. And look, you can tell by how the shares have performed year to date that investors are skeptical about this acquisition. You talk about the weaker margins, the mall exposure here. What's the risk reward here? I mean, is there a reward that potentially, Dick's obviously sees a potential reward.
Yeah, there definitely is a reward. It could be some years from now because Foot Locker is really in poor shape. It reported a negative 2% comp in the quarter, and it was unprofitable. And Foot Locker has been closing stores for years, and it's been underperforming for many years. It is a mall-based retailer, and mall-based retailers have been struggling. But there are benefits to Dick's. The acquisition will make Dick's an international company overnight because Foot Locker has stores in about 20 countries. And that's much quicker than anybody would have expected that Dick's would go international because right now Dick's only has stores in the U.S. Also, it prevents a competitor from buying Foot Locker. I do think that JD Sports may have bought Foot Locker if Dick's didn't, and I think that was one of the concerns that Dick's had. Also, Dick's is paying a good price for Foot Locker. It's buying it at only about 6 times trailing EBITDA or about 0.3 times sales. So it's not really overpaying for Foot Locker. So I did bring my fair value estimate up when Dick's announced the deal. I brought it up to $165 a share, but I do still think that Dick's stock price is overvalued. I may be one of the few people who actually does at this point, but I do think that people may be overestimating Dick's ability to maintain its recent great results, especially with the complications that will come with acquiring Foot Locker.
Okay, and Sveta, I want to go back to what you were talking about, not the Brady portion, but I know you have some insight on drivers of negative sentiment around Dick's, because one of the things I know you notice is Amazon, because you think about the competitive landscape, it's beyond just sporting goods. What are you seeing on that front?
I see that negative sentiment is at 30% just in the last 30 days, which is not terribly bad when it comes to such a large brand. But here's what it's driven by: customer service and issues related to customer service. This is where consumers come in, and 5% of all discussions that happen around Dick's were about the same issue and pointed directly to Amazon. Quote, more reliable than Dick's when it comes to customer service issue, especially highlighting shipping delays and general customer support. Other things that were mentioned and drove negative sentiment were, as my colleague said, tariffs. So tariff discussions and how those are impacting some of the industry. And again, retail thefts, which we obviously can't escape, came in consumer discussions, but also stock chatter. So the stock chatter and the earnings, the merger, were actually a negative driver and were probably even more significant than any of the other items that are brought up earlier.
We will leave our conversation there for today. That's Sveta Kalinska from Rila Global and David Soares from Morningstar. Thank you both, guys.